You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
Welcome back to another episode of Investees. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. This week on Investees podcast, we're going to talk about the biggest IPO in history. SpaceX is set to go public this Friday, June 12th. We're going to get into all of the details, but before we get into that, let's go ahead and review what took place in the market last week. The Dow was down 0.3% for the week. It held up better than the other two indexes, with the S&P 500 down 2.6%, breaking its 9-week winning streak. The Nasdaq was down 4.7%, the worst of the three indexes. Last week, towards the end of the week, we did watch a relatively violent sell-off, with Friday being the worst day for stocks since October of 2025. I want to go ahead and get into what dragged the market down. On Thursday, June 4th, Broadcom, the chip maker, beat earnings expectations, but missed revenue. So their earnings per share came in at $2.44 versus the $2.40 expected. So you have a 4-cent beat there. And then the revenue came in at $22.19 billion versus the $22.27 billion the street was expecting. As a reminder, you have analysts that are setting earnings and revenue expectations amongst other expectations within a publicly traded company, but those are the two signals that we follow the closest. It's important for us to understand that revenue expectations and earnings expectations are not necessarily tied to better or higher expectations year after year. It also takes into consideration what is happening in the industry, if there are macroeconomic impacts to that specific industry. So sometimes it may be that one year earnings and revenue expectations are lower than what the company brought in the previous year. In other words, the metric isn't always scaling upwards. Although it does tend to do that, it does in fact matter what is currently taking place in the economy. It may lower the expectations from how it performed the quarter before or the year before. I do think that there is a common misconception that analysts continuously expect for a company to outperform their performance in the previous quarter or in the previous year. But the analysts set expectations because they're taking everything into consideration, not only what's happening on a macro level economically, but also what's happening with the specific sector. In addition to that, the analysts are also coming up with earnings expectations based on how the company is saying that they are going to perform in the following quarter or for the following year. It is a way to hold the publicly traded company accountable to what they are telling their investors on how they will perform. So it's almost like a check and balance between the analyst that is holding the company accountable to where they said they would be throughout the year. For Broadcom, on this quarter's specific earnings report, they did increase revenue by 48% from the same quarter last year, and they increased their net income by 88% from the same quarter last year. However, the stock market did come tumbling down because it did not beat its expectations. So even though revenue was up by 48%, and even though net income increased by 88%, they still did not meet their revenue expectations. Remember, revenue came in at $22.19 billion versus $22.27 billion expected, which is what they agreed that they would be measured by. So in some cases, you may have a publicly traded company that doesn't at all increase their revenue or their net income from the same quarter the year before, but they do meet their expectations, how they thought they were going to perform, and you will see the stock market go up in price. In this case, it came tumbling down. In addition to Broadcom missing earnings expectations, the street was also expecting that they were going to raise their chip guidance for 2027. In other words, they were going to have a clear picture as of now, heading into Q3 of 2026, whether or not they were going to be able to raise their 2027 chip sales forecast, their forward guidance for 2027, specifically pertaining to chips. They were not able to. In addition to that, we learned that they are now going to be splitting their market share when it comes to Google with a Taiwan-based chip company. Before that, Broadcom had been an exclusive supplier for one of Alphabet's custom AI chip builds. This kicked off a really steep sell-off after the market opened. Broadcom came down over 15%, and then we saw what we call a sympathy play in the market, which means that other chip companies were punished out of sympathy. So we saw a ton of semiconductors, chip companies come tumbling down. This brought back the nervous jitters that we've been dealing with in the last 2 years in the AI tech sector. Then on Friday, we received the BLS report, which is the Bureau of Labor and Statistics. They publish a non-farm payroll report, and for the month of May, we performed much better than analysts expected. The U.S. economy gained 172,000 jobs in the month of May. This was up from the increase of 115,000 jobs in April. Analysts were expecting an increase of 85,000 jobs. So we did a lot better, coming in at 172,000 jobs. For our unemployment rate, the BLS reported that unemployment held at 4.3% compared to that number in the last 2 months. So 4.3% has held steady for its third consecutive month. We saw the most growth in the month of May from leisure and hospitality, leading with 70,000 jobs, followed by local government, which added 55,000 jobs, and social assistance adding 12,000 jobs. You would think that given the positive news surrounding the jobs report, that the stock market would be positive. But that's not the case. Here is why the stock market came down. In addition to the Broadcom report, which impacted the tech sector, the market did not want to see a positive jobs report. In order to understand why the market was unhappy, let's talk about what the expectations are for the Federal Reserve. The Federal Reserve operates under a dual mandate set by Congress. They have two responsibilities. One is maximum employment. They have to make sure that the labor market is as strong as possible, meaning that there is low unemployment and healthy job creation across the economy. So as of Friday, number one is checked. That is moving in a positive direction. Number two, price stability. Their job is to make sure that they keep inflation low and predictable. By the Fed's definition, it is important to have a 2% inflation target over time, meaning they want to see inflation no higher than 2% year over year. We are nowhere near that because we are currently on an upward trajectory due to tariffs and the war in Iran. The primary tool that the Federal Reserve has in order to tackle these issues is the interest rate policy. They decide whether we have lower interest rates or higher interest rates. When they raise interest rates, borrowing gets more expensive throughout the entire economy. This slows down spending and cools inflation. When they lower it, borrowing gets cheaper, which stimulates growth and hiring. It adds liquidity to the market overall. The stock market loves a low interest rate because, especially in the tech sector, more tech companies can borrow more money for much cheaper. It stimulates growth. It is the perfect scenario for tech companies. When we saw low interest rates during COVID, we saw an explosion in the tech sector. It costs money to make money. And if money is cheaper, then it becomes easier to stimulate growth. However, the problem here and the danger is in inflation, which is what we have been going through since 2021. Low interest rates will stoke inflation, most especially right now when we are trying to combat inflation. The answer to the inflation that we are currently seeing is to increase interest rates. And so now we have a positive job market on top of this, which is going to make it almost impossible for the Fed chair to lower interest rates. Remember, Donald Trump was angry at Fed Chair Powell because he did not want to lower interest rates, because he didn't want to stoke more inflation. Trump was sure that his appointee, Kevin Warsh, would lower interest rates. Now the market is assessing that the likelihood of that happening is extremely slim. It's going to be very interesting for us to see if Kevin Warsh goes against what Trump wants. Hopefully he does. I know that for a lot of us, we want lower interest rates, but we are also not thinking about how this is going to impact low-income communities. It is going to hit them even harder than they are currently being hit. And it is also going to impact us because I know food prices, everything is impacting us. It may not impact us as bad as low-income communities, but we will still pay the price for low interest rates, is what I'm trying to communicate. The market on Friday priced in that we will probably not have lower interest rates, which is why the market came down.
Study and play come together on a Windows 11 PC. And for a limited time, college students get the best of both worlds. Get the Unreal College Deal. Everything you need to study and play with select Windows 11 PCs. Eligible students get a year of Microsoft 365 Premium and a year of Xbox Game Pass Ultimate with a custom color Xbox wireless controller. Learn more at windows.com/student offer. While supplies last. Ends June 30th. Terms at aka.ms/collegepc.
Let's get into this week's episode, how SpaceX could be one of the largest IPOs in history with a valuation of around $1.75 trillion. What is an IPO? An IPO is an initial public offering. This is the very first time that a privately owned company sells pieces of itself, also known as shares, to us, the general public. Prior to the initial public offering, only a small group of people owned the company. This typically consists of the founders, the employees, early private investors like venture capital firms. There are two main reasons why companies go public. The first reason is to raise a lot of money. By raising a lot of money, they then get to reinvest into the company and grow. And of course, the goal after that is to eventually become profitable, right? We kind of talked about that in the first part of this episode, where we talked about how if cash is cheaper, that promotes liquidity and increases growth. The reason why the market is so upset that we can potentially have either higher interest rates or we don't get to see lower interest rates. So reason number one, a company goes public is to raise a lot of money. Reason number two is for companies to make good with their investors. So they bring in the cash and their investors now own shares. Their ownership is converted into shares, and then they can cash out on their investment. The worst thing that can happen is for an investor to have their money tied into a company forever and not get repayment. And of course, you want to receive some sort of interest on what you lent the company. And so this is one way to make good and for owners to cash out, whether it's to fully cash out or to partially cash out on their investment. Let's go over the simple steps of how this process works. You have a privately held company that decides to attempt to go public. The company files paperwork with the SEC, Securities Exchange Commission. This is the government's market regulator. The key document that they file is the S-1. Think of this as a company opening its books to the public for the first time, right? They're going to show us all of their financial documents. This is also a reason why a lot of companies prefer not to go public, most especially recently, because they don't have to answer to anyone else publicly. The only people they have to answer to are those that are the founders, the employees, and the private investors. So having to put all of this information out publicly has been a big deterrent, especially as of late, to come out and be public. After they have opened all of their financial books to the public, then we have investment banks, also known as underwriters, come in to set the price and line up really big buyers. This is called a roadshow. It's basically a sales tour pitching the stock to large institutional investors. The night before trading begins, they set the price. They decide on what the price will be per share. Then the next day, the stock starts trading on an exchange like the Nasdaq or the New York Stock Exchange under its specific ticker symbol. And from that point forward, no one controls the price necessarily. The price is free to move based on supply and demand. So we are the ones that set the price. Whether we want to buy in or not buy in, that is what starts to determine the price. It's really important that we have a distinction from what a listing is to what index inclusion is, because it can be confusing. So when a stock is listed, or known as a listing, the stock starts trading on the exchange. Like I just gave you the example. It's trading on the Nasdaq, it's trading on the New York Stock Exchange. For example, we have the Texas Stock Exchange soon. It will be trading on the Texas Stock Exchange. Anyone can buy it. Anyone that has a brokerage account can buy the stock. The next part is the index inclusion. This is when the stock gets added to a specific index. Every episode on Investies, for the most part, we go into how the Dow, the S&P, and the Nasdaq is trading. Those are indexes. That is a completely separate event. That happens later in time, and it's decided by the index companies, not the exchange, on who gets to be part of the index. There are certain requirements that each company has to meet in order to be a part of the index. So not every single company that is listed on an exchange is part of an index. Now, here is what we know about SpaceX so far in terms of where it is at in the process. The ticker symbol for SpaceX is going to be SPCX, and it will be listed on the Nasdaq, okay? The Nasdaq as an exchange, not as an index. That's where I know it can get really confusing, especially because the Nasdaq's index is the same name as the Nasdaq's exchange, but those are two different things. SpaceX filed their S-1 form in order to go public with the SEC on May 20th. On June 4th, the roadshow started, and then on June 11th, later this week, they will determine what the price will be on trading day. Their targeted trading day is for this Friday, June 12th. There is currently a proposed price of $135 a share. This can change, as I mentioned. They will have the final number by June 11th. The offering is roughly going to be 555 million shares. This will raise about $75 billion. The current value is ranging from 1.75 trillion to 1.77 trillion, depending on the outlet, which will make this the largest IPO ever. Elon Musk will keep over 82% of voting control even after it goes public. This is going to be through a special share structure. The lead banks on this deal is Goldman Sachs, plus Morgan Stanley, Bank of America, Citi, and JP Morgan. Here's where we have a lot of controversy coming in on this specific IPO because the rules have changed. Remember the distinction between the listing versus the index inclusion. Now, here is why that matters. Normally, a brand new publicly traded company has to wait before it's allowed into an index like the Nasdaq 100 or the S&P 500. That wait is really important. That timeline before they actually enter the index has always been historically important. They call it a seasoning period. This wait is about 3 months. And the idea for having this seasoning period is to let the stock price settle, to find its real price. A lot of the times when a publicly traded company IPOs, the stock tends to fall because you have all of the owners from when it was private cash out. And so once they start to cash out, you will see the stock price start to drop because there is less ownership in the company, and that impacts the price. Remember, we as the market determine the price. The more people that buy in, the more the stock increases in value. The more people that sell out, the more the stock decreases in value. This is a seasoning period. You want to see where the stock settles. On May 1st of 2026, Nasdaq changed its rules. Now, any newly listed company that's among the top 40 biggest by market value can join the Nasdaq 100 after just 15 days of trading. That 3-month seasoning period is gone. So not only has the seasoning period been eliminated, they have also eliminated the minimum float requirement. Let me explain. The amount of shares that the company has available to trade for the public is referred to as the float. And indexes have a minimum requirement of the company's float. They want to make sure that they have enough shares for the public to actually purchase. Companies with a small float can be weighted up to 3 times their actual size in the index. To make this easy to process, ultimately, it will make this share expensive to own very fast because the supply may be much less than the demand. If you have a high demand and limited supply, then that makes the share more expensive. To recap, the Nasdaq has changed its rules for how a company is listed on the exchange, right? Now we no longer need the 3 months seasoning period. We just need 15 days for it to be allowed to be on the index. And they have eliminated the minimum float requirement. What does this mean for SpaceX? This means that SpaceX could be fast-tracked into the Nasdaq 100 roughly 15 trading days after the June 12th listing this Friday. So potentially we could see it already on an index by late June or early July. I say potentially because it hasn't happened yet. It is believed that these rules changed specifically for SpaceX, so this is what we are expecting to take place. Critics on the street have nicknamed the rule change as Lex SpaceX, which means the SpaceX law, implying that the rule seemingly is written for one specific company. However, we do have OpenAI and Anthropic that are also lined up to become publicly traded. So they will also benefit from this law. There is no proof that the rule changed specifically for SpaceX, but the timing is raising a lot of suspicion. On the other hand, S&P 500 index did reaffirm their rules. SpaceX won't be eligible for the S&P 500 for at least a year after listing, and it would still have to meet the S&P's profitability and float requirements.
Growing a successful business has never been easy. But whether you're navigating a complex industry or trying to reinvent one, our breadth of banking experts are here to collaborate on market-proven solutions. At KeyBank, we're built to grow with your changing needs because we're not just here for the business you are now, we're here for the business you'll become. Reimagine business as usual. KeyBank opens doors. Learn more at key.com/B2B.
Let's fully go into what the impact will be when a publicly traded company like SpaceX becomes part of an index. When a publicly traded company joins an index, it now has to be a part of an index fund. Stay with me because the index is not the same as the index fund. An index fund is a basket of stocks that automatically holds whatever is in a particular index. So let's say the S&P 500 holds 500 publicly traded companies that have the largest market caps. Then an index fund that mirrors the S&P 500 has to also purchase and hold all of those 500 companies. These index funds tend to be the default option in most 401ks or retirement plans. So the index fund has to mirror its index. When a new stock gets added to the index, every fund tracking it is forced to buy that stock. No matter the price, no matter whether the manager of the fund likes it or not, no matter whether you like it or not, they have to make room and they have to purchase some of the stock in order to mirror the index accurately. And so once SpaceX goes public, 15 days after, when it is eligible to be a part of the index, it will immediately receive another injection of money because we have all of the index funds that need to buy in. It is estimated that they will receive an injection of $7 billion based on the purchase of the shares that will go to the index funds. Now, this is just an estimate because if the stock shoots up after IPO, then it's going to be a lot more expensive to purchase, meaning they will inject more than $7 billion. If the stock drops down after IPO, then it will be less than $7 billion. SpaceX has a relatively small float. Under normal circumstances, it wouldn't even hit the minimum requirement to be in the Nasdaq 100. And so what that means is that the more activity that this stock has upon IPO, the more that the price is going to increase, and it will increase faster than normal. SpaceX is currently planning to offer fewer than 5% of its shares to the public, and the old Nasdaq requirement was a 10% minimum float. So they are short by more than half of what they need to qualify under the old rules. We need to talk about the $1.75 trillion price tag on SpaceX because it's wild. On the S-1 filing, SpaceX reported that it brought in $18.7 billion in revenue in 2025. It was up 33% from the year prior, but it had a net loss of $4.94 billion. So it was not profitable. It lost almost $5 billion last year in 2025. So when we take a look at the $18.7 billion in sales and then look at the valuation of $1.75 trillion, that's about 94 times its sales. To help put this into perspective, let's look at NVIDIA, which is the poster child of the AI boom. It is one of the most expensive stocks that we have out there. It is currently trading at 21 times sales. So SpaceX would go public at more than 4 times NVIDIA's level. If you're going to purchase the stock and invest in it, you have to believe that SpaceX is 4 times more valuable than NVIDIA. Let's break down what is driving revenue in for SpaceX. When we think of SpaceX, I think the majority of us are thinking that it is a rocket launch business, but the reality is that it is 3 businesses under one roof. We have Starlink, which is satellite internet. That is driving in $11.4 billion a year. This is about 61% of the revenue it's driving in, and it is growing 50% a year. This is the only consistent profitable piece of the entire business model. So it has over 10 million subscribers as of February of 2026. Then we have the rocket/launch business, which brought in $4.1 billion. It grew 8% and did run at a loss because, of course, they're pouring in billions to develop the Starship. And we have AIX segment, which drove in about $3.2 billion in revenue. This includes the Grok AI and the X platform, formerly known as Twitter. And it also lost money. I want to double click here into profitability because I do think it's really important for us to understand the different perspectives that come with investing into different types of sectors and companies. I also want you to remember that you are listening to someone that has only invested, for the most part, in technology. And the companies that I've invested in, at least the majority of them, at one point were not profitable. This is because Technology companies continuously have to reinvest into themselves until they start to build a sustainable asset that can carry them, where they are highly profitable and have achieved self-sustaining free cash flow. I didn't get to see that from my Netflix investment until 2021, and I started investing in the company on January of 2013. But the amount of people that were financially savvy and would tell me that is the worst investment because of all of the debt they were acquiring due to their investments in original content and going global, I just had to ignore because I was investing into the future of the company and what it would potentially become. And it has been like that with a lot of my investments. And that is the tolerance that you have to have when you are investing in technology. The other thing that's important to understand is if you are investing into a company that is young or a startup, you are going to be investing into a company that is not profitable because they're reinvesting their money to grow, which is why they like cheap money to use to continue growing, which is why they want lower interest rates. Let's look into why anyone would want to pay that. Let's look at the bull case. What are the bulls saying? To be fair, there are smart investors lining up to pay this price. I want us to understand what their argument is, what their reason is, why they feel bullish on this specific stock. And it really is coming down to it being an internet company, an AI company, not a rocket company, which I think is pretty confusing, right? Because we know SpaceX to be a rocket company, but it looks like what people are the most excited about is the AI component, the Starlink component, which is an $11 billion broadband business growing 50% a year with really fat profit margins, okay? It's a platform, not a product. So they frame SpaceX as this only being a company controlling the whole stack of space, reusable rockets, satellite internet, Starship, defense contracts, AI computing. No other competitor owns all of it. Then the other take of this is if Starship does work, then it goes into a completely different universe. Starship is supposed to be the giant, fully reusable rocket. Bulls argue that if it succeeds, it slashes the cost of getting to space and unlocks entirely new markets. They call the valuation explicitly a bet on execution, and SpaceX has a real history of hitting milestones others couldn't. Okay, that's just the reporting. That is just a fact. Morgan Stanley has a report that forecasts SpaceX generating revenue that could hit $3.4 trillion by 2040. That is obviously a long time horizon number, which means that you would have to be patient and invested for the long term. So generally in the bull cases that we're seeing, it is people talking about having to be invested over 10 to 15 years and not necessarily look at it for what it is right now. And so you really have to think 94 times sales, a $5 billion loss, the rocket business that's barely growing, independent valuations saying it's worth half. Because not everybody's giving it the bull case that Morgan Stanley gave it. Both things are true. We don't know. That is the point. We do not know. It is most certainly a bet. When you are investing into a company early on, you are betting on the outcome. There is no proof that they are actually going to get there. You have to believe that they will get there, and you also have to understand that they may never get there. And here's the thing we know about Elon Musk and his already existing publicly traded company. He tends to generate FOMO frenzy. The run-up to this specific IPO has had everyone in a chokehold, at least for a large group of people. Bankers reportedly got twice as many orders as there are shares. Okay, so think about that. That is going to drive up the price. Reporting describes retail investors as chasing it in a quote-unquote FOMO-style rally-chasing way. So if you are considering purchasing this stock, it's going to be really important that you proceed with caution. The other thing to consider is that you do have these investors that are early investors when the company was still private. If they are going to cash in on some of their stock and get some of their investment money back, I would anticipate that they would do that after the company enters the index because of that $7 billion injection that it's going to get, given that it has a small float. I'm sorry, but all of this feels very orchestrated. I also want to make it very clear that I would never discourage someone from investing in something or encourage someone to invest in something specific. Yes, overall, I encourage you to invest. I want everyone to be invested. I would never place judgment, most especially on a person of color, depending on what they wanted to invest in. That is your business. It's not my business. It's not anyone else's business. You know, there's people that are like, why would you invest in an oil company? I'm not invested in an oil company, but I would never place judgment on someone that is. I represent families that work in oil. Texas is one of the states that produces the most oil here in the United States. A lot of our hardworking families work in that field. Imagine me condemning that sector. Those are real families. Those are real people that this is the nature of the industry here in the state of Texas. And so in that same way, I would never place judgment if you wanted to invest in this. But I do feel that it is my responsibility to give you the warnings and let you know that this scenario, the way it is set up, it's not sitting right. And I laid out the facts on why. The minimal float that they have, the 15 days that it has with no time to actually settle before it gets placed into an index, I just am cautious about it. So if you are a new investor, I would like to invite you to look at the stock and learn. If you have conviction and this is what you want to invest in, go for it. I wish you the best. I would never wish, for your investment or any of our investments to come down. I just want to make sure that you have all the facts and that you understand what you are going to be invested in and that you're not just moving based on FOMO. Lastly, I just want to share with you the history of how IPOs have moved in general. The average IPO pops about 18% in one day, and then we see the excitement die down, and by the 1-year mark, it has only grown by 3%. About a third of IPOs trade below their offer price by the end of day one, and roughly 64% of IPOs underperform the S&P 500 in their first year. A hot first day on IPOs are completely normal. I'm definitely expecting for SpaceX to have a frenzy. I can already see that it's going to be in the news all day on Friday. I think it's going to be really important that if you're new to investing, this is a really great case study. Just observe the stock. If you have decided to invest, I am wishing you the absolute best. I just want you to proceed with caution. We also have to take into consideration that we had a really weak day on Friday, and the impacts that we talked about at the beginning of this episode I think will most certainly have some sort of trigger on what ends up taking place with the stock, because this is something that is impacting the sector of technology. And also, we have macroeconomics to worry about. You're listening to Investys Podcast, a Cosmic Standard production. I'm your host, Linda Garcia. A special thank you to the team, Crystal Patino, Asia Simpson, Eliza Smith, and Jacob Winnick.
Close your eyes. Focus. Listen to work getting done with Monday.com. Relax as AI does the manual work, while your teams are aligned on a single source of truth. Feel the sensation of an AI work platform, so flexible and intuitive, it feels like it was built just for you. Notice you're limitless. Now open your eyes, go to Monday.com, start for free, and finally, breathe.